I have been meeting him since 2013, but this time there was an extra spring in his step. Yes, at 80, Henry Kravis remains an Indophile who doesn't hesitate to speak his mind. But KKR and Company's co-founder and co-chair has always been in equal parts avuncular and sharp-suited. This time, his red striped pocket square added that extra dash of natty quotient. Having deployed billions into Indian companies and infrastructure, his firm KKR, that was founded 48 years ago by three cousins, Jerome Kohlberg Jr., George R. Roberts, and Henry Kravis, all of whom who had previously worked together at Bear Stearns, leading some of the largest leverage buyouts of those days, is now less confused with an IPL franchise that share their initials. I met up with him for a freewheeling near 1-hour chat during his recent whirlwind tour of the country, where he met over 50 founders, promoters, and CEOs in just 5 days. And by the end of it, that number would probably have touched triple digits across Mumbai, Bangalore, and New Delhi. We spoke about a wide range of topics that included US job and capital market and the impact it has on deal making, exits, private equity consolidation, and where in India he will deploy the next big check. From cybersecurity to data centers, from financial services to consumer brands and AI, the scope is large. If India can be a low-cost and efficient producer and the infrastructure and red tape continues to get better, Kravis is confident the economy will attract more foreign direct investments. It's Friday, 19th of January. From the Economic Times, I'm your host, Arijit Barman, and you're listening to Corner Office Conversation with Henry Kravis of KKR, or should I say, Coffee with Kravis, only on the Morning Brief. Like last year, we're meeting in the same room in round about the same time. It was February, it's Jan, so we're heading into a new year. The markets seem to be thawing. I mean, Jay Powell, the US Federal Reserve Chair, has signaled that the cycle of rate rises may be over. On the other hand, private equity groups or large corporates that have been so far a bit restrained from large M&A or inorganic opportunities, they seem to be increasingly, there's an urgency to strike deals. So will capital markets and deal making make a big comeback in 2024?
Well, let me put it this way, and let's take the U.S., which is obviously the biggest market. We expect 2024 to be a fairly active year for us. Having implied that 2023 wasn't that active, which in the accuracy of it is that we were very active in 2023. You can always find opportunities if you're a global firm, if you are in different product areas, which we are. We have approximately 45 different products around the world. And so not every market goes straight up or straight down. Not all markets are open or closed at the same time. And so we've been exceptionally active throughout. What happens in the U.S. is it was a very strange phenomenon. You had very high interest rates because as the Federal Reserve and all Federal Reserves for central banks for that matter were attempting to tame inflation, the markets in many cases and the economies kept going. Usually doesn't happen that way, but it's a holdover in part from the amount of money that was put into the system during COVID. If you just take the U.S., for example, the Fed's balance sheet ballooned significantly from to over $7-8 trillion and from some significantly lower amount. And at the same time, the fiscal side, the Trump administration first and then the Biden administration put a lot of money into the system. So you had enormous amount of money put into the system, which is still partly in the system. It has not all been dried up or used or invested for that matter. So it's kept the employment rates high. The U.S. surprisingly has stayed very high. We have a 3.5% unemployment rate in the U.S., which quite frankly you would think would be a much higher unemployment rate given high interest rates. Presumably you have a slowdown in the economy. We haven't had a slowdown in the economy. You've had pretty much full economy. What's happened, it's just starting to happen now, is that it takes time for the effect of interest rate rises to really start to tame markets and to tame the economy more. The JOLTS, or job openings in the U.S., were running as high as 11 million job openings. That is starting to come down now. It's at or a little below 10 million. And I think that will continue to come as companies are saying, we don't need to hire as many people to really work its way through the system in the U.S. Mm-hmm. We're not counting on a recession in 24 in the U.S., but we're also not counting on a huge growth in the U.S. We think sort of steady as you go. Our belief is that inflation will stay higher longer than most people think, even though it is obviously coming down, but we think it should stay higher. And we think that and part of that's just inflation because of the labor issues that we've just talked about. A lot of companies are nervous about letting people go because they said, I don't know if I can get them back. And it was expensive to get them in the first place. And so they've held off until the margins start to get squeezed. And then they say, I've got to start letting people go. Mm. And then you've got transportation costs and other costs that will keep inflation higher than normal energy cost, et cetera, even though that's not part of core inflation. But that's just something you need to keep an eye on. So we think inflation globally will stay higher. I know in India, for example, you ran as high as over 7%. You're down to now more or less 4%. I think the target's to try to get it down to 3. Maybe you can get it to 3. And by the way, in certain developing countries, some inflation's not bad to have.
So going back to what I asked, that will this macro environment see the frenzy back both in capital markets and deal making, or it'll be slow and steady?
It's a function of prices. The stock market in the U.S. is opening up now. We just filed for one of our companies to go public. I think you'll see others starting to file and test the water, and we will see. There's capital interested in investing in the IPO market, but it's a function of pricing. You know, if the prices aren't right, companies, including us, we'll just wait and see. You know, there's nothing wrong with the companies themselves. It's a function of, is this the time or will it become the time to use the equity market there? The debt market has stayed open. So the debt capital market has stayed open. What has grown tremendously is the private credit market. Yeah. That private credit market has grown significantly in the U.S. and in Europe. And I think that will continue, particularly as banks have, the Western banks in particular, have raised the bar on types of loans they'll make and who they'll lend to.
Right. I'll come to private credit because that is also becoming quite an interesting space in a market like India. So bottom line, as you said, it will be a function of pricing. But private equity firms are already sitting with trillions of unsold investments, and many of their backers or LPs are demanding some of their money back before committing fresh capital into this particular asset class. Now, as traditional exit routes, which could be a sale to another company or flotation in the stock market, becomes a little difficult, some might argue, because of the macroeconomic environment, some of your peers are getting creative. They are increasingly embracing new financial engineering techniques, things like net asset value financing. I mean, Vista Equity Partners recapitalization of Insara was, I think, became a good case studies. Are we going to see more of that in 2024?
You'll see some of that, I think. We expect to have a fairly active disposal period for KKR. We have a large portfolio of companies, and we're constantly making investments and new investments, and we're constantly, liquidating or liquefying a number of those investments, whether it be through the public market. So now with the public markets starting to open up, and I think that will continue, as I said, in the States and in Europe. If that continues, yes, we'll use the public market. I think we'll use the public market here in India as a possibility for some of our companies. And then there are others that approach us all the time because we have a large portfolio of companies, and companies will come to us and say, we'd like to buy this or we'd like to buy that. And so we just evaluate. It's a function of price more than anything else. It's not large companies who have a strategic need. They're not phased so much by where the stock market is or isn't. If they've got cash and can get the cash and know that there is a possibility that they can really change their strategy by making an acquisition, they'll make it. And we're seeing that, and we're getting a lot of companies that are approaching us. And I think that continues. I can't comment about what others are doing or not doing. We have some investments that we've made that honestly we'd like to hold for a longer time. So we've gone to what is, I guess we call it an extension and financing, where we'll let our investors out if they want. You can roll over if you want. And we'll find new capital if that's what's needed, or we'll put more capital into the company ourselves. And we'll find a third party to set the price, so what the fair market value is, so that none of the investors feel that they're not getting a fair deal there. And they can get liquidity if that's what they want. The reason, in part, that a lot of institutions are saying, we need cash back is because almost by regulation in certain states, they are able to allocate only a certain percent of their total assets under management to the alternative space. Once they hit that, they're sort of shut then, and so they can't do much more. So that's why they need the cash back so that they can reinvest it somewhere else. So that's what you're seeing. As the stock market has gone up, all asset value then goes up. So that percentage is not as critical as it was when your market's down. It's the denominator effect is what you have there.
Yeah. It's also exits as one side of the spectrum. Fundraising, that's also the other side of the spectrum. People expect this to be the year of the mega capital raise as well. KKR itself is in the process of raising a new flagship fund, as are many of fast-growing firms such as Clearlake and others. So do you expect the PE asset class to only grow in heft and influence? Because there's already enough and more dry powder from the COVID years.
Not everyone's going to be able to invest all the capital that they have. And I'm not so worried about what other people are doing or not doing. I can only focus on what we're doing. And we're right on pace, almost every one of our funds. And we watch that. Most of the funds that we have have a life to invest of 5 to 6 years, and pretty much a linear progression. And so we watch that carefully. How are we? The worst thing that anybody can do is say, well, I've got money burning a hole in my pocket. We have to get the money out. I'd rather give the money back to our investors that we didn't find anything that made sense in this particular fund. But that's never been the case. If you have 5 years to do it, we have enough industries to go into, we are diversified enough, you'll always find opportunities. In addition to that, we have a very large part of our balance sheet today is in what we call core investing. And that means certain very large institutions that have given us a significant amount of capital where we can make investments in companies and never have to sell them. We can own those forever, let them compound. The institutions that have given us money said that's what we want. We're long-term investors. Our liabilities are long-term. And so we think we'll do much better as an institution, they say, by making long-term investments and letting those investments grow as opposed to giving us cash back, and then we've got to find another place to put it to work. So we have today maybe 16 or 17, 18 companies, something like that, in what we call core investing at KKR. And those are very good long-term investments that theoretically should have a lower rate of return to some degree than our funds. But it's the idea of the power of compounding, which is the eighth wonder of the world.
Any of those 16 or 17 are in India?
I don't think so. No.
Okay. KKR, Blackstone, Apollo all went public around 2008 financial crisis. Last year, all three stocks skyrocketed. That's probably what's influencing many others to tap the capital markets or test the public markets in 2024. Would you see enough appetite for private equity stocks even in the US and Europe?
You know, we're all different. If you take Apollo, Blackstone, and KKR, for the longest time, we were looked at as the same kind of firm. We were a private equity firm, and that was it. Today, we've spread out and are different businesses. In our case, we're almost a quarter between real estate, credit, private equity, and infrastructure. Yeah. Today, to be more correct on it, about 30% of our assets are in private equity. Credit would be our biggest piece today when you take Global Atlantic, which is our insurance and annuity business, along with our private credit business. That just in assets would be the largest. Infrastructure is growing very quickly and coming up, as is real estate. So we're very diversified, and as a result of that, people are saying, look, you have so many ways to win. So let's take where we are. We have more or less 45 products. Many of those products are very young products. They're very new products. And so we have a lot of growth ahead of us. The fact that we now own 100% of Global Atlantic gives us lots of ways to win, lots of ways to distribute credit-like products through their different channels that they distribute, annuities and so forth. And so we have the opportunity today to do a lot of things that we couldn't do before. So if somebody's saying, you know, does KKR, as an alternative investment firm, not a private equity firm, but as an alternative investment firm, have many ways to win? The answer is yes. And they're saying, you know, I'd like to participate in that because it's the way for us to see growth. We have a balance sheet of over $30 billion today. And again, that helps us start new businesses, helps us fund existing businesses that we're already, funds that we're already in and so forth. So there's just a lot of ways for KKR to win through these different product capabilities. And with so many of them very young, the oldest product that we have is U.S. private equity. But then you can go right through a long list, which I won't do. And the investor looks at it and said, wow, the power of compounding, the fact that as a shareholder now, they have a lot of permanent capital, so they don't have to worry about can they raise money next year. You know, we have a huge amount of our capital is permanent or quasi-permanent capital. That's very important to an investor. Mm-hmm.
Also, the last 1.5 years, we're seeing mega consolidation. EQT bought out Bearings. There are reports of GA eyeing Actis, BlackRock looking to, something transformative, eyeing Warburg Pincus. Is consolidation inevitable in an industry like private equity? Will KKR do something similar?
Probably not. We don't need to because we have the seeds in the ground for all the business that we need. We don't need to go buy another private equity firm. What are we going to get out of that? That's duplicative of what we have. Same with infrastructure, same with credit. I mean, maybe there's a credit business somewhere that, would help us in a particular geography that we don't have. That might be something someday. I don't know. But we don't have to. We have enough growth without having to buy. And we cover the waterfront as far as alternative investments are concerned.
Coming to India, over the last 2 to 3 years, it's really brand new KKR, new blood, new ideas, new strategies. Something's changed, or the core remains the same, it's just new people?
I appreciate the question, but I have to say I think it's a little bit of a misconception of new company. We have some people, we got a deep bench here, and a number of those people have been with us for years. Rohan's been with us, I don't know, ever since almost started, when we started out here, and others have been too. Yes, Gaurav been with us 3 years. He came in as a new head. Akshay just came on board 6 months ago. There's nothing new. It's just we're growing. And, I always like to think of a corporation, any corporation, as an evolving entity. And all too often, institutions will look at, they have a picture of KKR on their desk, and these are the people that are there. And, oh my gosh, 3 people are gone, the firm must be falling apart. Well, it doesn't quite work that way. Yeah. And or maybe they just changed their mind of what they wanted to do, and we needed a different kind of person to take over. It doesn't mean that the company is worse off. In fact, I'd argue the other side, probably the company's better off. And so in India, yes, we have a lot of new blood, but they're not new to the industry. It's not as though, think of it like a football team. Yeah. Okay, guy knows how to play tight end, and whether he's got one jersey on or another jersey doesn't really matter. Yeah. We haven't changed philosophy. We're not changing.
So does that mean, if I can bring some numbers, till early 2023, KKR had deployed 10 billion in India. I'm sure by beginning of this year, it would be a little bit more. Will you deploy the next 10 billion faster than you did before in India?
Yes. India is a high priority for us. India is an anchor for our Asia-Pacific investing. Japan's an important part of what we have. We still have in China about 15, 16 companies. We still continue to make some investments there. We're not pulling out of China. And so those are the pillars. But India is probably the most important of it and the biggest opportunity. Look at the size of your country. Look at the size of your economy as it's growing. And if you can grow it more or less 7% a year, I think there are things that can be done where you could grow 8 or 9% a year. That's huge for us. Yeah. And so to take advantage of that. And we will continue to put money to work. We now have a mature team and infrastructure here, which we didn't have 5 years ago. It was a newer area for us. We have a credit business that we'll do more on. Real estate is becoming a possibility for us. And certainly growth equity here, private equity here will continue to grow. We're just seeing more and more opportunities as people are watching what we've done and said, we'd like to partner with KKR. We see what you've done with companies. We see how you've improved the value of the company, and we'd very much like you as a partner. And we're seeing more and more of that. We have a number of opportunities right now that are live. They're real opportunities. Yeah. Here, I obviously can't tell you which ones they are, but I've been very impressed with the people I've met in my first 3 days here. And some of them are new to me, certainly not new to the firm, but new for me, meeting them. And their enthusiasm and say, KKR brings something that we don't have. They bring a global view. They bring a capital markets capability. They operate as one firm, so we get the whole firm. So those things are value added to so many companies here. So I see us putting more money to work, infrastructure, possibly real estate, certainly in private equity and growth equity.
But does the first 6 months of 2024, going up to elections, it's more a wait and watch, or it doesn't really matter?
Well, obviously it matters who's elected. I have to say I'm impressed, very impressed with what this government has done. I've been coming to India since 1989. I come this time, and last year the same thing, and I just see it getting better. Infrastructure is improving dramatically here. The can-do attitude is now starting to really take hold here in this country, which is terrific. It didn't used to be that way, and I think it is very much that way. So they call it the atmosphere and stage is set for us to want to do more here and the ability to do more. And I wouldn't say that the first 6 months we're going to sit on our hands and wait and see. We will not. We have opportunities, as I mentioned, in the pipeline now. I meet with government people here every time I come, and what I'm hearing is very positive from being pro-business, pro-growth, pro-help the underclass in this country, bring them up, and then simplifying a lot of red tape. GST is a phenomenal thing that happened in this country. Productivity of that alone, just huge.
Yeah.
I see other things like that taking place.
A lot of the India Shining story rests on this continuous bull run that we're seeing in the equity markets, 4 years running. Our key index, which is the Nifty 50 stocks, is trading over 20 times, a 27% premium to its 18-year average. Does that therefore make public market trades impossible and just too expensive?
Never say never. What I would say, it's going to depend very much on the company. If we look at a company, and yes, it's trading at a high multiple, but it's trading at a high multiple because the company needs repairing, and it can be improved significantly, and therefore we can bring the earnings up significantly. Unfortunately, we've got to pay for it to do it, but that's not going to stop us from making that. But there's so many private companies that need capital that we don't have to rely on just the public market as a source of investment for us. And by the way, what goes up comes down, and what goes down comes back up. And so we're not market timers. So the market is high, but it's high for a reason in part, and that is the growth prospects of companies today is much higher than it was. The infrastructure in this country is getting better and making it easier for companies to operate. A lot of the red tape is being cut out in this country, making it easier to operate today. So to me, all of that's positive, and therefore earnings for companies are higher and better than they might have been, pushing the stock market up. There's an encouragement for individuals to own shares, which there wasn't before. That's positive. There, it's a way to recycle capital for a wealth distribution, which is fantastic. And so all of that's very positive as people are playing. What you hope doesn't happen in any country, it's not just India, it doesn't become a casino.
Right.
And I don't think that's going to happen here. But that I'd say in any developing country is a problem, because people say, oh, it's so easy to make money, and they put all their savings in, and all of a sudden the market doesn't continue for whatever reason.
Yeah.
I hope that doesn't happen here.
So what does that mean for KKR? In such an environment, would you rather put your money in tech companies whose valuations have plummeted and are up for grabs at mouth-watering valuations, or some of the new frontier sectors which are opening up, EVs, green hydrogen, or stick to the core knittings, core infrastructure, where there's still room for growth? You launched India's first highway trust in 2022. So, where are those pockets there where you see?
It's wherever there's a need. So you look at cybersecurity, you look at renewables, energy transition. Those are areas that we like. Security is one area that we happen to like. Industrial businesses that are not operated particularly well. Financial services is an area that we happen to like. Healthcare is a need. Anywhere where we see that there is a need, as your population matures, the population has more income coming in, that middle class grows. Consumer products, where the middle class ends up with more capital that they can then spend, more earnings that they can spend. We look at those as positive. Look at the number of people that use the internet. That's growing significantly. I think call it 800 million plus or minus. Here, last count, of people that use the internet. So we will find opportunities on infrastructure. You're right. The Highway Trust is innovative, and we saw that as a real opportunity and a need. Data storage, data warehousing is a very big need here, and on and on and on. So yes, we're going to pick and choose. We are not a firm that is only focused on technology or only on healthcare or only on whatever industry you want to pick. If we see opportunities where we think we can make the company better, keep in mind, we always say our job begins the day we make an investment. Please don't congratulate us when we make an investment. Any fool can make an investment. That's the easy part. The hard part is what do you do to create value? And that's really what we're good at. We can create value by just operating a business better or bringing our capability to help a management team or a family that owns a company better than it might be operated on their own. And that's where you're making your money.
No, your exit in Max, I think, was stellar. I mean, it was unprecedented that such volumes of shares got sold in public market. I think it was unprecedented. I think around 51% of the company changed hands in public markets. But why I raised technologies, I guess also because of Akshay's background. He, in his previous avatar, looked at a lot of these internet companies, and they, as you said, wherever there's a need, and many of those companies are in dire need of money.
Look, technology is here to stay. Right now, all you have to do is put AI in your name and you're going to get a higher evaluation. I've thought maybe we should add AI to KKR, KKR.ai. The reality is not everyone's going to succeed in AI. Yeah. AI will be a tool, and it'll be a very important tool. This probably will be one of the most important things since the advent of the internet. It's clearly going to make companies more efficient, effective, and it's going to be disruptor in many ways too. A lot of jobs will be dislocated because of AI, et cetera. But it is not an end-all. It's a tool, and I think has a long way to go. AI's been around a long time. It's just getting better than it was, and it will continue to get better. And there's a wave. It's here to stay, in my view. But we will use it in our companies if it's going to help us become more effective. We will use it at KKR if it'll help us analyze companies better, faster, find niches where there are investment opportunities, et cetera. We will use that, but it is not an end-all.
We're seeing a lot of global supply chains getting realigned. It's been happening since COVID. Apple and several of its vendors have moved away from China. Tesla is again honking at our gates. But are we discounting China a little too much too early on most counts? I mean, look at EV solar panel exports from China. They're still the highest in the whole world. And this China plus one, I mean, we are trying, Mexico's trying, Indonesia's trying, Vietnam's trying. I mean, it seems the whole world is trying to be the plus one. It's becoming a crowded party, isn't it?
Supply chains are becoming more mobile. More companies are, and a number of our companies are doing the same. They're hedging, and they're putting supply chains in several locations as opposed to just relying on one location. If India can be a low-cost producer, efficient producer, your infrastructure continues to get better, you'll attract more companies coming here. The reality is, if you look at U.S. companies in particular and some European companies in India, they actually haven't grown since last four years, let's say, of number of companies coming in and staying in it. In fact, many of them have pulled out. That's not us because we're investing in Indian companies that are here. Maybe for them, they find the regulation too difficult or transportation costs, whatever it is, too difficult. That doesn't pertain so much to us because we're partnering or buying local companies. It's the same thing in China. We have bought local companies. We're not in the face of the government there, and these are just good, long-term, solid businesses. And so, yes, that plus one, there's no question about it. But the reality is, it's not going to all go to India. It's not going to all go to Mexico. It's not going to go where you name a country. You're going to see it spread out.
You talked about private credit. Several of your peers seem to be busy pivoting to it in a big way. Banks did retreat, and large private credit investors stepped in into that void to finance big buyouts. But banks won't sit out for long, and would hope to re-emerge as a credible option to private equity sponsors. We're already seeing, in your case, in Cotiviti, there are, serious amount of competition as to who gets to finance the transaction as it nears completion. How do you see that space evolve?
I think private credit's here to stay. Look, banks are here to stay. They've got huge balance sheets, and that's important. In the end, we really need them to syndicate a lot of the loans that we have here. So don't ever count out the major banks. Even with regulation tightening and becoming more difficult in the U.S. and in Europe with banks and financial institutions, the ones that will get hurt the most there, I think, will be the smaller banks, community banks, and so forth. But the big money center banks, they have more expense. They have more people that live in their office that are regulators than they used to have. But they're not going out of business. And, private credit is an alternative for a company to find the credit needs they need. And if a bank, for whatever reason, cuts back, then private credit can pick it up. There's a need for both. They're not going away, neither of them.
And you've been a pioneer of private credit in India. A lot of water has passed under the bridge. The business got merged with Cred, as you mentioned. You're taking baby steps again. How will KKR Private Credit 2.0 be different from the past?
We probably won't do it through an NBFC. I think we'll do it, if we're going to do it, we'll do it directly that way. We may do it in partnership with somebody. We may do it ourselves. We've got a good credit business now, which we've learned over the last 5-6 years in Asia itself. And so we have more experience than we had before. And I don't see it that much different than what it was before, except that we'll probably do it more directly as opposed to through an NBFC.
Last February, you said, and I quote, India needs to tighten its bankruptcy law. It looks like it's in a beta mode right now. And your message to the government then was, if you can clean up all your bad assets and come up with a good bang, you can raise private capital. Would you still say that? Or there's been some positive changes in that?
First of all, there have been very positive changes. I had a role in helping the awareness of creating a need for a bankruptcy law, which you didn't have. That restricted the capital markets. So I was absolutely amazed how fast that Prime Minister Modi and the government was able to get a bankruptcy law approved. I'm not sure we could do it that fast in the U.S. It was impressive, very impressive. Number one. Number two, I've said in the past, and I say it here, that in order for any country to grow, and India is no exception, to grow their economy, you need a very broad and deep capital market. Having a bankruptcy law will help that. But I think all the enabling regulation, not restricting regulation, will help that. So you need a broader, deeper capital market in equity and in credit. You need a securitization market, in my view, that will help a lot. I would probably urge more ownership by foreign ownership in your financial institutions, and let them bring capital in and use those insurance companies. Now, you've come a long way. You went from 25% max to 74%. Now, why not 100%? Ownership, and maybe over time it will get there. So any kind of regulation that is enhancing a growth in capital markets and encouragement for corporations to set up shop in India and to bring capital in, you need foreign direct investment. And that has stagnated to a degree here. You need to figure out how, in my view, to do that. Well, one thing certainly is to continue to improve the infrastructure. You've improved the infrastructure. Secondly, climate. Companies want their employees to be where it's healthy. And if your climate is so bad, that's not conducive to attracting talent to your cities or to your country. So all of these things are extremely important. So ESG plays a very important role, in my view, in what needs to be done. But capital markets, regulation, taxation will all encourage, if it's done the right way, will certainly encourage growth in this country and certainly will encourage more foreign direct investment.
Thank you so very much for your time. It's always a pleasure to talk to you.
Well, nice to see you again, and thank you for taking the time to interview me.
Thank you. So that was Henry Kravis, up close and as candid as it gets. Hope you liked listening to this episode as much as we did recording or chatting with Kravis himself. A big shout out to the team that brought this episode together: sound designers Rajas Naik and Indranil Bhattacharjee, and the producer on ground Vinay Joshi. Executive producers Anupriya Nair, Anirban Chaudhary, and yours truly. Thank you for listening, and if you like this episode, do spread the word among friends and on social media. All new episodes of the Morning Brief podcast drops every Tuesdays, Thursdays, and Fridays. It streams on Amazon Prime Music, JioSaavn, Spotify, Apple and Google Podcasts, and of course, ET's own audio platform, ET Play. Hope you have a great weekend ahead. Goodbye and good luck. All clips used in this episode belong to their respective owners. Credits mentioned in the description.